Hello everyone, welcome to my video. I am Dr. Satyanarayan Rao, and in this video we will see what is statistical arbitrage. Earlier I made a video on algorithmic trading where I briefly talked about statistical arbitrage. In this video we will talk about a bit deeper on pair trading strategy that actually uses statistical relationship between two stocks to identify trading opportunity. And we will also cover the essential statistical concepts like co-integration and stationarity that is needed to understand pair trading. And towards the end of this video, we will also see a simple Python implementation using Kaggle datasets. I found a Kaggle dataset with over 1300 stocks. We will try to implement a co-integration technique using this dataset to identify which stocks or which stock pairs are most suitable for pair trading. Let's start the video with a bit of historical context. So it was in the 1980s in the Morgan Stanley company. There was a scientist by name Gary Bamberger who thought that what if stocks weren't entirely independent, but some of the stocks were actually related to each other. It's like husband and wife relationship. Their emotions are often connected. If one is happy, the other is happy too, and the emotional factors affect people's relationship. Bamberger thought that in stock market, similar relationship could exist for economic reasons. For instance, certain stocks might share the same raw materials like Pepsi and Coca-Cola, or even belong to same industry like Tata Steel and Tata Motors, because Tata Steel supplies steel to Tata Motors and they both belong to same parent company. Or even some follow similar market trends like BMW and Mercedes. They have similar consumer demand and they fall under the same market area and they are the part of same index funds. So Bamberger wondered that what if this relationship could be quantified between two related stocks and exploited, so that when the prices of one of these stocks diverges temporarily, we can make use of it, and we will see how. And so to bring this idea into life, Bamberger actually teamed up with his another colleague by name Nunzio, and together they actually assembled a team made of not traders or businessmen, but physicists, computer scientists and mathematicians. And together the team built what's famously known as the black box model. People thought that the black box model was something cutting edge because it made huge profit for the Morgan Stanley company. And so it created a huge buzz in the financial world. But as time passed by, academic papers were out explaining what could be the black box model. And it turns out that it was rather a simple statistical concepts like co-integration and mean reversion techniques that we will see what it is in the coming sections. We will cover step by step what is statistical arbitrage, co-integration and stationarity concepts. And we will see how we can implement them in Python. The idea of statistical arbitrage is simple. Like if we have two companies of similar nature, their stocks are interrelated. For example, let's say we have two companies of steel. The price movements of steel is likely correlated because of the demand in the steel. When there is a bridge or a road construction, we will have a demand in the steel, and so the stock price movement of two major steel companies will move with the same phase. Or if we consider Pepsi and Coca-Cola, they both have same raw materials like sugar and flavor agent and other chemicals, and so they also have same consumer demand. If it's a summer, people want to have more cool drinks, and so when I see Coca-Cola stock going up and when I see that Maaza or fruity stock is being undervalued, it's reasonable to believe that the fruity will eventually rise And it's similar in other industries as well. For example, when there is a silicon chip shortage in China, it impacts multiple companies in the same industry. So if I see that due to silicon shortage, if Apple shares drop, it's reasonable to expect that similar effects on other stocks like HP, Dell, Microsoft, or even other semiconductor industries. Even in auto sector, we always see that BMW and Mercedes often have similar trading patterns. They both are in the same index funds, and their price movements are influenced by the same capital flows. So when one stock, like let's say BMW or Mercedes, leads or lags behind the other one, it creates an opportunity for a pair trading strategy. And this works because fund managers often rotate between sectors. The hedge fund managers wants to take out money from steel industry and put it into IT industry. So when one stock in the steel industry fall, it's likely that the other steel sectors will also fall. And so these stocks tend to move together always. And when we notice that one of the stocks in the similar industry deviates from this pattern, this is an opportunity to profit from this statistical arbitrage. So let's see what is pair trading. It is actually a simple strategy that is on the concept of relative pricing. Let's say we have two stocks that actually maintain certain relationship. We call it as cointegration. For example, is a statistical property that if we have any two time series, they will maintain a long running similar relationship, or we call it as equilibrium. And then when one deviates unexpectedly, the other will eventually come back to that position. It's like a rubber band. And so when one of the stocks deviates from the expected behavior, the economic forces will pull it back to the expected price level. And so whenever such kind of divergence happens between two related stocks, let's say Tata Motors or Tata Steel, because they are of the same parent company, Tata Steel supplies steel to Tata Motors, and when we see a divergence in their price, we can assume that the other will eventually they will come back to the same level. And this is where the opportunity lies. The idea is to sell the overvalued stock and buy the undervalued stock. So we expect that their prices will eventually come back to their historical equilibrium, and once the equilibrium is reached, we can close both the position and get the profit. And this is the basis of pair trading. So to understand what is co-integration, we need to know a concept, what is stationarity means. So a time series is defined to be stationary if its statistical properties such as its mean, variance and autocorrelation structure remains same or constant over the time. It means that the data is predictable in its behavior over a long term. This data are the two time series. If they are stationary, it may drift like from one another, but it will always oscillate around a constant mean with the fluctuations that have consistent variance. So mean, variance and autocorrelation of stationary signal will remain same over the time, and this concept is used in the co-integration. So we define if two time series, it can be two stock prices or anything. If we have two time series xt and yt, it can also be weather or temperature or any time series. If zt defined as yt minus beta xt, if there exists a beta value such that zt, which is defined as the difference between these two stock values, and zt if it is stationary, which means it has the same mean, covariance or autocorrelation, then we say that xt and yt are co-integrated if their difference with the beta is stationary. This is the definition of a co-integration. So we need to understand another concept known as spread. So in the context of co-integration, the term spread refers to the value of z of t in the equation that we saw earlier. And so when we have two time series, we saw that if there exists z of t as a function of y and x, so that it's stationary with beta as a constant that describes the proportional relationship between two stocks, then Z of t is the spread. We call it as the difference or the spread between the two stocks, and this spread Z of t is actually what we use in the pair trading because it reflects the deviations from their historical relationship. When Z of t is stationary, it means that the spread doesn't drift indefinitely and the spread always oscillates around a mean value, and any temporary divergence in prices like Pepsi rising faster than Coca-Cola is likely to revert back to this mean, which we call it as a mean reversal, and it is the trading opportunity. And if spread widens, one stock is likely overpriced and the other is underpriced, and when spread narrows, the stock returns to its equilibrium. So spread is like a signal, an actionable signal that is used in pair trading. For example, if we take the Pepsi and Coca-Cola as an example, and if ZT is defined as the price difference between Pepsi and the Coca-Cola with a beta value, what it means is that when the log of Pepsi's price deviates too far from the log of Coca-Cola's price adjusted by beta, and the system actually naturally tends to pull back to equilibrium. This behavior actually occurs because the stationary spread, or spread is the difference between two price value, ensures that large deviations from the mean are actually unlikely to persist statistically. So in simpler terms, if ZT is stationary, that means the mean of ZT remains constant, so the difference or the spread has a long-term average value, and any deviation from this mean represents a temporary price mispricing that will create trading opportunities. And when the spread widens beyond a threshold, it is expected that it will converge back, offering a chance to buy the undervalued stock and sell the overvalued one. So it means that if Pepsi's stock price increases significantly due to market hype or some factor, it is temporary in its relation to Coca-Cola stock price, dictated by the stationarity here that we define here, because they are co-integrated, will mean that the Coca-Cola's price will eventually match that of Pepsi's because of consumer demand or shared raw material and other things. And so it ensures that relative movements between them is relatively predictable. And this is what is known as the mean reverting behavior in the financial markets. So after we learned what is stationarity and co-integration, let's see what are these three statistical behaviors two stocks can exhibit. The first one is the random walk. So here I describe the random walk as x of t is equal to x of t minus 1 plus epsilon t. So x of t is the today's stock value, for example, which depends entirely on x of t minus 1, which was yesterday's value, plus a random component. And this random component, epsilon t, is the random noise or shock or unpredictable changes caused by factors like COVID or market news or any other disaster or anything. And so this epsilon t makes a stock a random walk, and this means that each step is independent of the past and there is no fixed mean or long-term patterns. And stock prices often follow random walk, and because the price movements often follow unpredictable information every day, and this randomness epsilon t makes our stock prices non-stationary, meaning that they can drift indefinitely without reverting to any baseline. And then we have the stationary signals, which means mean reverting signals. So here x of t is mu plus epsilon t, where mu is the mean or the long-term average value, and epsilon t still represents our random noise, but it causes fluctuation around this mean value rather than an unbounded drift. For example, epsilon t is still around the mu here, and so this means that if two stock prices like Pepsi and Coca-Cola that oscillate around a constant value mu, this is what we call it as mean reverting behavior. So no matter how far the series deviates from the mean, it will eventually come back. And stationarity is a critical concept for pair trading, and we will see its Python implementation shortly afterwards. Finally, we have the definition of co-integrated series that we saw in the earlier slide, where y of t is defined as beta x of t plus z of t, where x of t and y of t or time series, and we can have x of t and y of t could follow a random walk as we saw here, but still x of t and y of t can be non-stationary, exhibiting a random walk. However, if there exists a beta such that this equation is valid, then we say that these two stocks are co-integrated. So individually they can be non-stationary, they can have a random walk, but together, if we can establish a beta such that this equation is valid, then we say that the z of t is stationary or x of t and y of t are co-integrated, even though individually they can be non-stationary. And so I hope with this we have understood what are the three possibilities in the stock behavior, and now we can proceed to develop a Python implementation that identifies co-integrated pairs from a Kaggle dataset, and then we will do a pair trading strategy. So I was searching for a nice data set, and then I came across this huge stock market data set that is available on Kaggle, and it's created by Boris Marjanovic. It's a pretty old data set, it's 7 years ago, and so the data is like comprehensive with open, high, low, close and volume, as well as open interest. And so this data set is a good choice for our pair trading strategy. And so let's go into my notebook. So if you go to the codes, and there are actually a lot of codes already done on this data set. And so if I go to recent, I think it's the recent one is the one that I ran it just before making this video. So here is my notebook. So in this notebook, actually we are implementing the statistical arbitrage using pair trading strategy. So the goal is here to identify stock pairs with a stable relationship and exploit the temporary price movements as we discussed in the earlier part of this video. So I will share the link of this notebook in the description. And so in the first step, I am actually importing the libraries and exploring the dataset. So we are using the pandas for data manipulation, NumPy for the numerical computations, and as usual matplotlib for visualization. And the stat models here, the stat models is a worthy library for statistical analysis, and it has specifically the function that we need, the coint function, which is the co-integration test. It will test whether two stocks are a co-integrated pair by giving us a p-value. So we are importing the coint function from stats model here. And also we will need random, because we have too many stocks, so we will just take randomly 100 different stocks to just check among them what are the pairs that are statistically relevant for pair trading. And so here I'm just loading two stocks just to see if we can plot it. And so here you can explore other stock pairs by forking it and modifying it. And so here I select a.us.text or aa.us.text, two stocks, and then we are trying to see if it is imported correctly, and we see the open, high, low and other prices here. And so here we plot it, and here the two stock prices. Next we actually normalize it here, the stock prices, by dividing each price by its initial price level. So why we need normalization is that it makes stocks comparable regardless of their absolute price values. As a next step, we need to align and clean the data. So before comparing two stocks, we align their trading dates to ensure that we are working with matching data points. The dates should match. And so we also clean the data by removing any missing data here. So if you see, we are in this step we do the alignment of the two stocks, as well as we remove the missing data by dropping anything that is a NaN value. In this step we are just we are still with the two stocks that we randomly selected at the beginning. And so here we are doing the co-integration test. This test actually checks whether the two stocks we selected earlier has a long-term statistical relationship. So this returns a p-value that indicates a probability that the relationship occurred by chance. And so a p-value less than is by norm that if p-value is less than 0.05, that means that statistically significant relationship exists between the two stocks, making suitable for pair trading. And if p-value is higher than this value, let's say it's 0.7 or something like that, then it means that the stocks are not co-integrated and we should try another pair. So what we get here by running this code is that it has a value of p as 0.74, which means the stock that we selected is not a co-integrated stocks, and so we cannot do pair trading, and they are like independent, and they don't obey mean reversion or other tests that we discussed in the earlier step. And so it's pretty easy to implement a co-integration using stats model. It's just a function coint, and we put the two time series together and get the p-value. And if p-value is less than 0.05, then we choose those stocks as a candidate for our pair trading. And next what we do is we have like 1300 stocks in this data set. So we randomly select 100 pairs because of the computation, and then for each pair we do the same process. We align the data, clean the data, remove the missing values, and then run the co-integration test. And the pairs with p-value less than 0.05 will be saved as potential candidates for trading. In our case, let's see what we find. So here we do a random walk and then select randomly 100 stocks, and for example 200, which means we select 100 pairs, and then we check for we do all the steps that we discussed before, and then what we do is we actually normalize it here and do the co-integration test. And if p-value is less than 0.05, we group them, we append them here into co-integrated pairs list, and we have a print statement that these two pairs are co-integrated, else we don't do anything. And then when we run it on 100 random pairs, what we found was we found 6 pairs that are actually worthy of pair trading. For example, these are the 6 stocks that has p-value less than 0.05. So once we have these 6 pairs, what we can do is plot it and see the spread, the mean value, and other standard deviations. And we can also calculate the z-score, which quantifies how far the spread is from the mean. So that's what we do. We collected all the co-integrated pairs and then do some plotting, and here we see that how it looks. It may not look the same, but the p-value says that they are co-integrated. So next what we do is we will generate the spread. As we earlier saw, that the spread is the trading signal that actually tells us to whether take the trade or not, depending on the co-integration. So the spread is nothing but the difference between the two normalized stock prices here. And so I have marked some lines here, like blue line is the spread, the mean, and the standard deviation, and we will generate the trading signal based on the z-score. So the z-score is the current price minus the mean value divided by the standard deviation, which tells me how far the spread is from the mean. And if z-score is greater than 2, we are above the upper band, less than 2, minus 2 is below the lower band, and based on z-score we have the different trading signals. So it's, for example, here z-score plus 2 means we have to sell the expensive stock and buy the cheap one, and if it is minus 2, it means we long the spread. It means we buy the cheap stock and sell the expensive one. So here we plot the z-score and other trading signals in the code, and you see the upper and the lower band, and we see when to take the trade based on this value. And so whenever we have the lower band, we initiate this long trade, and whenever we are in the upper band, we can initiate the short position. And also I write some mean, spread values and z-score on the selected co-integrated pair tests. So this notebook is a starting point, and I suggest that we can do more, like test more stock pairs from the dataset, and I'm sure there must be more recent stock dataset in the Kaggle, and we can also experiment with what kind of profits we make, calculate the profits assuming that we do a synthetic trades with different thresholds for Z value. And so as a summary, we began this video with a brief historical perspective on statistical arbitrage. We know how it had origins in Morgan Stanley, where a group of physicist mathematicians did the black box model, and then we also explored concepts like cointegration, spread, stationarity, and saw how we can apply to pair trading strategy. And finally, we implemented these ideas in a simple Python notebook using a Kaggle dataset. And so thank you for joining me so far. I will be back with another video soon. Till then, keep learning and enjoy life. Thank you.